Hello, and welcome to the 2026 Property Market Update for Tasmania. I'm Angus Moore, and I'm the Executive Manager for Economics at REA Group. I'll be taking you through a high-level overview of what we're seeing in housing markets, as well as the economic conditions that are underpinning them. To that end, I'll start with economic conditions today, focusing on that sort of backdrop that sits around housing markets and the outlook that we might expect to see for rates, inflation, etc. I'll then move over into talking about what we're seeing in the established market, focusing on home prices, but also talking a bit about what we're seeing in terms of activity across Hobart. I'm then going to talk a little bit about rental markets, both because rental markets are interesting in their own right, but also because of what they're meaning for what we're seeing from investors. And investors have been a really important story nationally over the past sort of 2 years or so in housing markets. I'll then wrap up with a few themes that I think are going to be important for 2026 and potentially beyond. So let's start with that economic backdrop. And here in 2026, there's kind of nowhere I can start when talking about the economy than with inflation. So this chart here shows what we call underlying inflation. This is a bit of a technical term, but the idea is that it strips out from inflation the sorts of one-off, temporary, transitory things like electricity subsidies or fuel prices that don't really matter for when you're thinking about, where inflation is headed and the underlying momentum in it. This is the measure that the RBA prefers to use, and so, it's the measure I'm going to talk about here. Couple things that you'll note from the chart. First, inflation got way above the RBA's target band coming out of the pandemic. You can see just how high inflation was, and that's why we saw the RBA responding the way they did with, those very rapid, and successive rate hikes, that we saw through 2022 and into 2023. But the other thing that you'll note is, coming into 2025, underlying inflation actually got back inside the RBA's target band. That's why we saw rate cuts last year, but then has moved back out towards the end of last year. And on the red there, which is the RBA forecast for inflation, you can see that the RBA is expecting that that's going to continue and actually, go higher from here, and inflation won't get back inside their target band for probably 18 months or so. That's why we saw the hike that we saw in February, and why, as we'll talk about in a moment, there's a pretty good chance we'll see further hikes. The RBA is really laser focused on getting inflation back inside their target band, and so it being too high has driven that rate hike. What that's meant for mortgage rates is what this chart here shows. So this is the average mortgage rate for a new owner-occupier borrower. So, if you're a new owner-occupier and you went to a bank, what rate on average would you be getting? You can see the effect of the rate cuts that we had last year. Mortgage rates did come off their peaks, but we've already started to see that be reversed. And, markets are expecting that there's at least one more hike to come this year, potentially a second by the end of the year as well. Depending on what day you're looking at market pricing, it's anywhere from a sort of 40 to 50% chance of that second rate hike. That leaves mortgage rates a little bit lower than they were because that, sort of third hike is not necessarily fully priced in, but we will be getting potentially back to, pretty similar levels to where we were at the start of 2025. Now, inflation's obviously, as we were discussing, the kind of key thing that's been driving that and has been a really, kind of absolutely determining factor in rate hikes. But it isn't the only thing that's driving rate hikes. The case for a rate hike is also supported by the fact that unemployment is really very low at the moment. And that's what this chart here is showing. So the purple here is just showing the unemployment rate over the last 5 decades. At the moment, late 2025, unemployment is sitting, kind of low fours, which is very low by historical standards. Now, it's not the lowest we've ever seen. You can see, coming out of the pandemic, unemployment was even lower again. That was a very hot period for the economy. But, it is still very low by historical standards. And importantly, the RBA kind of expects that to continue. That's what that red line there is showing. That's their forecast. They have unemployment still drifting up a bit, consistent with, what it's been doing over the past few years. But, even by the end of their forecast horizon, still fairly low by historical standards and probably still sort of around or maybe even a little bit below what they would consider neutral. Now, neutral is a little bit of a slippery concept here, but the sort of idea is that there's some level of unemployment, of tightness in the labour market, of growth in the economy that's consistent with inflation being stable and within the RBA's target band. If unemployment's too low, that puts pressure on wages, puts pressure on prices, pushes up inflation. And so, at the moment, with unemployment very low, inflation moving back above the RBA's target band, that does suggest that unemployment is actually a bit lower than the RBA would like to see. And so that's supporting the case for a rate hike. But perhaps the more interesting question is, why is unemployment so low? And, if you look closely at the chart there, why did it actually move down towards the end of 2025? It had been a little bit higher earlier in the year. Part of the story is that we're starting to see consumer spending pick up. So this chart here is just showing consumer spending relative to the end of 2019. You can see that big fall that we had during the pandemic. Unsurprising, things were shut down, people locked down, couldn't go and spend money. As the economy reopens, as borders reopen, you see, spending pick back up. But then if you fast forward through to sort of late 23 through 2024, spending's more or less tracking sideways. And that's despite the fact that population's actually growing pretty strongly through this period. And so the fact that, consumer spending in total is tracking relatively sideways means it's actually pretty soft in, per capita or per person terms. If we fast forward through to 2025, particularly the last 6 months, you can see that line starting to head up with a bit more momentum. We are seeing a bit more strength in consumer spending. And importantly, population growth has actually slowed down, as we'll talk about in a moment, compared to what we were seeing a couple of years ago. And so in per capita terms, this, sort of firming in consumer spending is actually even a little bit more strong. Another way that you can see this, perhaps more complicated way to see this, is this chart here, which breaks down economic growth into the sort of types of spending that are driving that growth in the economy. So the things to focus on here are the red, which is private sector spending, so that's households and businesses, and the blue, which is government spending or public sector. And if we focus in on 24, 25, what you can see is that through 2024, those red bars are quite small, meaning that consumer spending, business investment, were not contributing a lot to growth in the economy. They weren't going backwards, but they weren't contributing a lot to growth. Whereas government spending in the blue was. We were seeing relatively brisk growth in government spending through that period. Partly that's state government infrastructure, partly that's things like NDIS, and that's contributing to economic growth. But as we move into 2025, that story actually flips. Government spending or growth in government spending starting to tail off. We're not seeing, as big blue bars there. That's partly state government infrastructure projects winding up. But we're also starting to see more contribution from private sector spending. So that's partly consumer spending, like we were talking about before, but it's also business investment, which has been firming up over 2025. And so that environment of, stronger private demand, stronger private sector spending is also contributing to inflation. That's something the RBA called out in their, post-decision statement as supporting the case for a rate hike. All right, let's move away from kind of rates and the economy and talk about something a little bit closer to housing markets. And that's population growth. So the chart on the left here is showing annual population growth in the purple for national and then in the orange for Tasmania. I'm going to start with the national because, slightly different story. What we've been seeing nationally is a period of very strong population growth, largely driven by overseas migration post borders reopening. That process has mostly worked its way through nationally now. What happened after borders reopened was we saw a lot of people coming into Australia, but not a lot of people leaving Australia because we hadn't had anyone come in during 2020 and 2021. And so net, that is in less out, was quite strong. Here, 4 years later, we're now at the point where people that arrived in 22 and 23 are having their visas expires and they're leaving. And so that adjustment process has largely worked its way through, and we're getting back to a more normal pace of population growth. But for Tasmania, the story is a little bit different. And that really comes back to the chart on the right. So that's what I'm going to talk about now. Chart on the right breaks down Tassie population growth into what drives population. So in grey, that's natural increase, which is just births less deaths. We can mostly ignore that. Blue is not overseas migration. We've spoken about that already. You can see that, tailing off in recent years. But the more interesting one for Tasmania is interstate migration, which is the red. Tasmania, not entirely uniquely, but relatively uniquely among states, actually sees quite a swing in interstate migration. Lots of other states are relatively constant in always seeing inflows, if you're Queensland, always seeing outflows, if you're New South Wales. But Tasmania has swung between net inflows and net outflows by quite a lot over the past couple decades. And you can see, that period in the late 2010s, there was significant inflows into Tasmania from other parts of the country. That drove very strong housing demand through that period. It's part of why Tassie was in a bit of a housing boom even before the pandemic, when, the rest of the country was seeing pretty soft conditions. But you can then also see, that flipping around in the sort of post-pandemic period, and more people leaving Tassie for other states than coming from other states towards Tassie, leading to pretty soft population growth across Tasmania. Population has been growing, but at pretty slow pace, and that's been reflected in the housing market outcomes that we'll discuss in a second. So that's a nice bridge into talking about home prices. So let's start with this chart here, which is just showing how home prices have evolved over the past 6 years. What you can see is that home prices today are about 40% higher in Hobart than they were 6 years ago. That's how to read the chart. But interestingly, much of that happened during the pandemic. And in fact, if you push this chart back further, Hobart was going through a real boom prior to the pandemic as well. But once you get to early 2022 and the RBA starts raising rates, as we saw, population outflows, population swapped from being net inflows from other states to net outflows, housing demands cools off, rates are going up, affordability is very challenging, home prices start falling, and they're actually yet to recover in Hobart. Regional Tasmania, similar story, though not quite as stark. Home prices track sideways rather than falling, and have been a bit firmer in the past 12 months. 2025 saw a bit of a rebound for Tassie. It was the first year that we'd really seen consistent home price growth since the RBA started raising rates. That wasn't unique to Hobart. Melbourne has had a pretty similar trajectory, not quite as large a fall post rate hikes, but really hadn't seen much home price growth until we got to 2025. But you can see that as we got to the end of 2025, price growth did soften off again in Hobart. Again, that's not unique to Hobart. Melbourne saw similarly, Sydney saw similarly as well. Where it does differ a bit, and just to draw a bit of a contrast, is Brisbane and Perth and Adelaide, not shown, but largely look the same as Brisbane here. Brisbane, Adelaide, and Perth have seen prices more than double in the past 6 years, and 2025 was kind of no exception. Home prices continued to grow very strongly across 2025 through all three cities, and kind of showing no real signs of slowing down. Just drilling into Perth a bit more, just drilling into Hobart a little bit more before we move on. We've mostly been seeing prices for detached and for higher density following one another over the last sort of 4 years or so. You can see that there was a gap that opened up during the pandemic when the prices for detached houses grew faster than prices for higher density. So think semi-detached and apartments here. That's not unique to Hobart. We saw that in pretty much all parts of the country. And that's consistent with, people wanting a bit more space at home, wanting a bit of backyard during the lockdowns. That gap has remained though post-pandemic, but we really haven't seen as much of a difference in performance. Units were a little bit softer through the last sort of half of 2025, whereas the falls for houses were really concentrated right at the end of the year. Though I don't want to put too fine a point on that. Obviously unit prices can be a little bit more volatile given it is a smaller market in Hobart. And broadly speaking, we have been tracking together for much of the last sort of, post 2022 period. Where we have seen a little bit more of a difference is that more affordable homes have done a little bit better over the last year or so, and in general, really since the RBA started raising rates. And that's consistent with the very challenging level of affordability, pushing people towards more affordable homes, more affordable parts of the cities. The slowdown that we saw towards the end of 2025 was across all segments. You can see, the blue line there for the more affordable segment, the purple for the sort of mid-market, and then red for the sort of most expensive homes. All of them flatten off, but the falls that we saw were really concentrated amongst that more expensive sort of top quarter of the market. Similarly, if we look across the city, the strongest growth that we saw last year was, up in the northwest and Brighton area, while the inner city area there was relatively soft. Look, prices were still up, but it was not as strong as what we saw in the northwest. And just to wrap up on the established housing market, in terms of activity, last year was a fairly average year for activity across Hobart. So this chart here is showing new listings by month. It's a bit of a complicated chart, but listings are obviously very seasonal, vary a lot month by month. Not a lot of people list in winter or in December. Lots of people list in spring. So you want to be able to compare months against months. And that's what this does here. You can follow each color, that's a year, and compare it to other years. And so 2025 in the blue, a little bit quieter than 2024 in general, but roughly speaking around average, maybe a little bit busier through sort of September, October, but a little bit quieter through winter than a typical year in Hobart. All right, I'm going to change tack now and talk a little bit about rental markets. Tasmania's had an interesting experience with rental markets over the past few years and a little bit different from what we've been seeing in some other parts of the country. You know, Much like housing markets, rental markets in Hobart and to some extent regional Tasmania were actually tight before the pandemic, which wasn't the case in many other parts of the country. So rental vacancy rates, which is what this chart here was showing, were already down at 1% before the pandemic began. Rental vacancy rates are very volatile, as you can see here. Rental vacancy rate is just the number of homes or number of rentals that are available as at the end of the month for someone to move into as a share of the total number of rentals. So you can see why it's volatile. It depends on which month of the year you're looking, whether people are moving around and rentals are becoming available as a result, and even, when within the month people are moving, because, this is taken as a snapshot at the end of the month. So you have to kind of look through the broader trend. And when you do that, what you see is, very tight rental markets before the pandemic, through the pandemic, we're seeing very strong rent growth through that period. But then, as those population outflows, or as that population shifts from net moving into Tasmania to moving out, we start to see rental markets ease off. And actually by, 2023, in contrast to what we were seeing in a lot of the rest of the country, rental markets were back to a sort of, 2% rental vacancy rate, which is, still on the tighter side, but getting back towards normal. But actually, rental markets have continued to get tighter over the last sort of 2 years, which again is a bit in contrast to what we've seen in many other parts of the country where availability has been starting to improve a bit. You can see that in the panel on the right there, which is showing in red for capital cities as a whole. You can see across the combined capitals or even across the combined regional areas, rental vacancy rates more like 2.5 prior to the pandemic, falling to, 1% in 2022 and 2023, but then sort of drifting up over the last couple of years towards, more like 1.5%. Still very tight, but not as tight. What the conditions that we're seeing in Hobart and regional Tasmania mean, though, is rent growth is still growing pretty quickly over the last sort of year to 18 months. You can see that in the median advertised rents here for houses in pink and units in purple. After a period through 22 through 22 and 23, where rents mostly tracked sideways as that availability was a bit better, as that vacancy rate was a bit higher. And you can see that actually rents had been growing prior to the pandemic at a pretty brisk pace in Hobart. There's not, unlike what you see in some other capital cities where it's sort of sideways into the pandemic, up very strongly in sort of 21, 22, 23, and then starting to level off now as availability improves a little bit. What that means is that, unlike some other parts of the country, we didn't see as big a pickup in investor activity in sort of 22 and 23 because rental markets just weren't as tight in Hobart and rents weren't growing as strongly. And so this is kind of a nice way to see that. This is showing the number of investor loans, new investor loans issued by quarter for Hobart as a whole. It's a nice way to think about sort of investor purchases. Not every investor will be buying with a loan, but many of them will be. And so it's about the best proxy we have for investor purchases. You can see during the pandemic there, a lot of investor activity. That's not actually a story about investors. That's just the pandemic being very busy, a lot of loans in general. You can see that quieter period as the RBA raises rates, as rental markets get a little bit quieter in Hobart, a little bit looser in Hobart, conditions ease off a bit. And that lull staying through 23, 24 and into the start of 2025. But then as rents start to grow again, as vacancy rates start to tighten up, you're starting to see a big pickup in investor activity in Hobart. We've been seeing a lot of investor activity around the country, as we'll talk about in a moment, but this sort of delay and then pickup here is actually quite similar to what we've been seeing in Victoria. In terms of where this investor interest and investor purchasing is concentrated, it is overrepresented in the Northwest here, where price growth or recent price growth has been strongest. You can see this chart here just shows the share of inquiries on realestate.com.au that are coming from investors. The deeper the red, the higher the share. It is very concentrated in that Northwest area. Again, this is not a pattern that's unique to Hobart. If we look at the capital cities around Australia, the sort of more outlying, more affordable parts of the cities are seeing disproportionate investor interest. Though in places like Brisbane, Sydney, Melbourne, the inner city is also a very popular area for investors because they are big rental markets, a lot of renters, a lot of rental properties. Just to wrap up on investors, another way to kind of look at this is, not just what investor activity is, but, what investors are making up of the buyer pool. And that's what this chart here tries to do. This is showing the share of loans that are going to investors by state. So at the moment in Queensland, in the blue there, 40% of loans are going to investors. Now, that doesn't mean 40% of buyers are, because not all buyers are buying with a loan, but it's kind of the best proxy that we have. In Queensland, it's not quite a record, but it's very, very high, as high as we've seen. In WA, same story. In SA and T, it basically is a record. September was the record. December's just slightly down, but basically at a record level. New South Wales, 45% of loans are going to investors. It's not a record. New South Wales has had some periods with very high investor participation, but still very high by historical standards. And then you can see in Tasmania at the moment, again, at sort of about a third of loans going to investors in Tassie is high relative to what's true typically. And while we haven't seen as much of a pickup, not as noticeable a pickup in the sort of 2022, 23, 24 period, in that 2025 period, we have. And you can see that in Victoria as well. Victoria saw a fairly long lull in investor activity through 22, 23, 24, but towards the back end of 2025, really saw investors start to pick up. I'll wrap up there on investors and I'll move on now to a few themes that I think are going to be important for the rest of 2026. And the first of those is building construction and residential construction in new homes. Chart here is showing on the left for national, on the right for Tasmania, how many homes we're actually completing building. In red for detached houses, in blue for higher density, so semi-detached and apartments. And the black line there shows the pace that we would need in order to hit that National Cabinet target that they've set of building 1.2 million homes over 5 years. At the moment, we are a long way behind that target. And the big difference at the moment, nationally at least, is in higher density. We're just not building as much higher density as we did a decade ago, despite the fact that we're a bigger country than we were a decade ago. Now, there are some signs that's changing, and I'll talk about that in a moment, but to date, we haven't seen that. The residential construction sector has been a fairly challenging one for the last sort of 5 years or so for a few reasons. We saw big increases in costs during the pandemic. Building costs were escalating very, very rapidly. It's been very difficult to source labor, and it's actually taking longer to build homes, particularly for detached houses. So that's all a fairly negative picture, and the fact that we're a long way behind the target's fairly negative as well. But I want to finish on a more positive note, which is that things look like they're starting to head in the right direction. Building approvals, which lead completions, because buildings get approved before they get built, do look like we're starting to see a bit of an increase, particularly in higher density. Still nothing like what the pace that we would need to hit the target, but we're at least headed in the right direction. Similarly, those headwinds that I was talking about, they're certainly not gone. It's certainly not an easy environment for residential construction, but it does look like we're starting to head in the right direction. Building costs are still high. They're still much higher than they were pre-pandemic. There's no indication that they're going to come back down, but they've returned to a more normal pace of growth. And so we're just not in that environment of, uncertainty around costs that we were in 2021 and 2022. And so that makes life just that little bit easier for builders. Similarly, skilled labor and labor availability, it's still a challenge, but there's some signs that it is starting to ease up a little bit. We have seen an increase in employment in residential construction over the last sort of 12 to 18 months. And similarly, build times are still longer than they were pre-pandemic. It's still a challenge, but they are starting to head in the right direction, which again, is a sign that things are headed in a more positive direction. The second thing I want to talk about is first home buyers. And the reason for that is that we saw some policy changes towards the end of 2025 to support first home buyers from the federal government. And those are listed here. So that's the Australian Government 5% deposit scheme, which allows any first home buyer to buy with a 5% deposit without having to pay LMI. This scheme's actually existed for a while in various guises, but the The change that was made on 1 October was to remove the income eligibility thresholds. So previously you had to earn under a certain income in order to be able to take advantage of the scheme. And second, to remove the cap on the number of places. So the scheme was previously capped at 50,000 places. That has now been uncapped. There is still a cap on how expensive the home you can buy is, though it's relatively high for a first home buyer, about 700,000 in Hobart. That will matter for some first home buyers, but for many, who tend to be looking at the more affordable end of the market, that may not be a big constraint. The second scheme here is the Help to Buy scheme. That's a newer one, came in early December. It's what's called a shared equity scheme, where the government kind of buys alongside you and owns a stake in your home. This one does have caps on income and on the number of places, so I suspect will be a much smaller and more limited scheme than the 5% deposit scheme. Now, by reducing the deposit burden, allowing first-time buyers to buy with a smaller deposit, not have to pay LMI, this is clearly going to allow some first-time buyers to buy sooner and pull forward some first-home buyer demand. And there is some evidence that we're actually already seeing that. So this chart here is just showing the number of first-home buyers, and you can see if you zoom right into the end of the chart, that very last point there does tick up a bit. And that very last point covers, the last 3 months of 2025, which is the first 3 months that this expanded scheme was in operation. Now, a first-home buyer would have to have been pretty proactive to get on the scheme, find a home, buy and settle between 1 October and end of December. But, maybe some have. And so there is maybe some evidence here that we are starting to see the impact from that scheme. But also, the number of first-home buyer loans, as you can see from the chart, does bounce around for a whole lot of reasons. So we can't pin all of it on that 5% deposit scheme. But it'll be interesting to see through 2026 what the impact of that scheme is as we start to get more into the scheme. More people have had an opportunity to get on the scheme and start to take advantage of it. Whether we start to see that showing up in materially higher first home buyer numbers. To the extent that we do, that's obviously going to be concentrated in those more affordable segments that first home buyers tend to prefer. And then to wrap up, the last theme I'm going to finish on is also where I started, which is inflation. Inflation really is going to be what dictates what happens to the cash rate this year. So this chart is a way that I like to make that point. And what it shows here is in black what the actual cash rate, the actual RBA target cash rate has been. And then in the different colors, what markets were expecting the cash rate would do over the sort of subsequent couple years at different points in time. So in red is back in late October, so not even really that long ago, we were expecting 2 cuts. But then we get the September quarter inflation data, and it shows that inflation is more persistent than expected, higher than expected, and so we move to the blue line, expecting 1, maybe a little bit over 1 hike. And then we get the December quarter data in late January, and it shows that actually no, inflation is even higher than we thought, even more persistent than we thought. And we move to the purple line, where we've already seen a hike, and at least 1 more is expected, and as we spoke about at the start, probably a 40 to 50% chance of a second hike. And so the point to make here is twofold. One, that's the outlook for rates. We're expecting 1, maybe 2 more hikes from here. But importantly, that outlook is entirely driven by what happens with inflation. If inflation turns out as the RBA is forecasting, probably, it'll look a bit like the purple line. But equally, things can change very quickly, as evidence from this chart and how quickly we've gone from expecting a couple cuts to a couple hikes. If inflation turns out not to be as persistent as we thought, if that September and December data turns out to have been a bit of an outlier, then we may not see as much of an increase in the cash rate as is currently priced in. So with that, perhaps unsatisfying crystal ball gazing, I will leave it there. Thank you very much for your time. I hope you found that very useful. Thank you.